Okay, good afternoon, grade 12. I will be continuing from where I stopped yesterday. We're looking at different risk factor of investment opportunities, and we look at different investment opportunities businesses can go for. And we've spoken about the government retail bonds. We've looked at buying a unit trust. We've looked at shares, and we look at the risk factor of each and every business opportunity. And we've looked at that of the unit trust, we've looked at that of the shares, and I also told you that the risk factor for a share depends on the type of share that you buy. And we have two types of shares. Number one, I'm on page 73. We have an ordinary shares. It has the highest number of risk, as the investor may lose full or part of the investment when the company is being dissolved, bankrupt, or the company is being liquidated. And we also have what we refer to as a preference share. So we have two types of share. We have an ordinary share, we have a preference share. So preference shareholders' risk is lower. I actually want you to underline that. So which means an ordinary share member has high risk and a preference shareholder has a low risk. Why does an ordinary share member has a high risk? In the time of liquidation of a business, when a business is closing down, an ordinary share member might not get paid out. So it is the preference shareholders that get paid first. They are being preferred first. So if there's any leftover, that is when an ordinary share member gets paid. That is if there is something left over for an ordinary share member. So that is why they have an high risk. But a preference shareholder has a lower risk, as they have preferred claims on the asset of the liquidated company, may receive some compensation before an ordinary shareholder. So which actually gives you an insight that if you want to buy a share, you must actually go for a preference shareholder that has a lower risk. And we have fixed deposits in the bank. It has very low. Please, I actually want you to underline that. It has very low, as the investor will receive what was agreed upon. So we're talking about a fixed deposit. You will always get what? A fixed return, a fixed interest rate. No matter what happens in the economy, in terms of inflation, in terms of economic meltdown, like what we are experiencing now, a fixed deposit will always get what the interest rate has always been in the first instance. The return will not be affected by the market fluctuation. Remember, all these factors that we're looking into in terms of the share, they actually fall under the economic factor in the macro environment. That is why we're speaking about an economic fluctuation that goes up and down. And we also have a managed portfolio as a form of investment. The risk is lower. Please underline that. Over a longer period of time. Investments are made in various sectors or companies. So which means a managed portfolio, I can decide to buy a share or invest my money in the primary sector, in the tertiary sector, in the primary, the secondary sector, and a tertiary sector. Therefore, the risk is spread and better managed by a portfolio manager. And me looking at the characteristics of a managed portfolio, I think it makes sense, because if there is an economic meltdown or that affects the primary sector, or in terms of drought, or in terms of water scarcity that is affecting the primary sector, if I have some investment in the secondary and the tertiary sectors, those ones might not be affected. And we also have a debentures. A debenture have a low risk, as they must be paid back. And we have fixed property, lower risk over a longer period of time. When you're talking about the fixed property, you're talking about buying buildings and so on and so forth. It has a low risk, and at the same time, it appreciates over a longer period of time. Risk may be determined by economic condition. I actually want you to underline that, which may influence the value of the property. We also have mutual funds or stokvel. Money in a savings account is safe investment, but with a low interest. That is the disadvantage of having all those stokvels in a savings account. It is a safe investment. Your money will be in your account, but the interest rate is very, very low. So the risk is also low at the same time. There's one thing I actually want you to understand. If you put more in your as an investment, you earn more and you stand to have high risk at the same time. So if you invest less, you have less risk, and at the same time you will have a less return. Business venture or a venture capital, like I explained yesterday, it is an high risk for an investor if the history of the company is not well researched. So it is an high risk because, let's take for example, you putting money in someone else's business that is just starting from the scratch. There is no guarantee that the business will be successful. So for you to put lump sum like R1 million, it is a big risk. It is an high risk. And which means before you put money as an investor, as a venture capital into any business, you need to do your research and be sure that, okay, this business is going to be profitable. This business is going to be sustainable before I put my money inside that. But in a situation whereby you just put millions of rand into an entrepreneur's business, someone that is just starting a business, someone that is just entering into a competitive environment, it is an high risk because there is no guarantee that you're going to get a good profit from investing in that kind of a business. And second to the last one, we have the endowment or the life insurance policy or the retirement annuities. They also have a low risk as the insured amount will be paid out regardless of the circumstances. And we have the 32 notice account, or we call it a core deposit, which we spoke about yesterday. It has a low risk as investment plus interest will be paid out on the maturity date of the investment. Interest is calculated on a daily balance, accelerating the value, the return on the investment, and lowering the risk at the same time. So which means when you look at it properly from what we've read and explained, putting money in the bank is actually safer than any other forms of investment businesses can go for. So let's now look at the types of shares on page 75. Number one, we have what we refer to as an ordinary shares. What is the description? Standard shares with no special right or restriction. There is no special right, there is no restriction. Shareholders may receive higher dividends when the business makes what? Large profit. So which means that the ordinary share members can also receive lower dividends if the business also make less profit. And there's one thing I actually want you to make note of. An ordinary share member, there is no fixed interest rate that is being given to an ordinary share member. There is no fixed interest rate. And for preference shareholders, these shares enjoy a preferred claim on company assets in the event of bankruptcy or a liquidation. So a preference shareholder actually have an upper hand than an ordinary shareholder. And they do have what? A fixed, please underline that, a fixed rate of return is paid on this type of a share. So which means if you buy a share and you go for a preference shareholder and you have been given a 10% interest rate or 15% interest rate, you will be paid 15% interest rate. If the business is making profit, you will get 15% interest rate. If the business is running at a loss, you will still get your what? Your 15% interest rate, which makes it preferable to any other form of any other type of share. And number three, we have what we refer to as a founder's share. It is a share that belongs to shareholders who started the company. It is a share that belongs to shareholders of who started the company. And lastly, we have a bonus share. Shares that are issued to existing shareholders as compensation. Please underline that, as compensation for loss of dividends. Remember, when you're talking about shares, we're talking about investing money in a company and you make profit, but we do not call it profit. We use the term dividend. So another word for dividends is actually profit, but when you're talking about shares, we don't call it profit, we call it a dividend. So what is the difference between an ordinary and a preference share? Please, this question is always in the question. Make sure you get used to it. What is the difference between the two? Let's look at an ordinary shareholder. Ordinary shares only receive dividends when profit is made. So if there's no profit, it means you're not getting any dividend. On the part of its preference shareholder, some of these type of shares receive what? Dividends regardless of profit that is made. Because it says some of this type of, we have different types of preference shares at the same time. We have the cumulative, we have the non-cumulative. We will be talking about that later. And they receive dividends regardless of the profit that is made, because you've already given a preference shareholder a fixed interest rate. So whatever happens in the business is not their problem. They need to be paid first. And on the ordinary shareholder, what is another difference? Normally, the higher the profit, the higher the dividends. That is for an ordinary shareholders. But for preference shareholder, a fixed rate of return is paid on this type of share. So which means, like I explained, a preference shareholder will get a fixed rate of return, which is going to be 10%, 12%, irrespective of what happens to the business. Shareholders under the ordinary shareholders are the last to be paid. I actually want you to underline that. They are the last to be paid if the company is declared what? Bankrupt. You know what bankruptcy means. We spoke about strategies. We looked at type of strategies, and we look at the defensive one, and we looked at retrenchment. We look at divestiture before we look at retrenchment, divestiture, and we look at liquidation. So in the time of liquidation, ordinary shareholders are the ones to be paid last. That is if there is money left. But preference shareholders have a preferred claim on company assets in the event of bankruptcy. That is very, very important. That is a clear distinction between an ordinary shareholders and a preference shareholders. Let's now look at the rights of preference shareholders in the company. Number one, they do receive dividends regardless of how much profit is being made. They do receive a fixed rate of return or a dividend. They are paid first, enjoy preferential right to dividends. They have a preferred claim on company assets in the event of bankruptcy or liquidation of the business. So when the business is liquidating, it means they are selling off every of their assets. Whatever is being realized from the sale of those assets, they need to pay the preference shareholders first. And also, they do receive interim and an annual report. When you're talking about an interim report, that will be a report that is being issued within the first 6 months of the year. They need to know what is going on in the business. And they only have voting right at the annual general meeting under particular circumstances for certain resolution. And we have impact of these forms of ownership. Let's look at the pros and the cons of each and every of these forms of ownership. Yeah, I think we will be looking at 4 of them before I round up today. On page 77, let's look at the advantages and disadvantages of, the government retail bond. Number one, advantage. I'll first speak about the advantage and I'll take the disadvantages afterward. What is the advantage? There is a guaranteed return, as interest rate is also what? Fixed for the whole investment period. Number two, investment may be easily accessible, as cash may be withdrawn after the first 12 months, subject to penalties. So if you withdraw your cash within the 12, it's easy for you. You can withdraw your cash within the first 12 months, which is a year, but it actually comes with a penalty. No charges, no commission payable on this type of investment. And at the same time, it's very, very accessible. As an advantage, it is being sold at the post office. You can always get the government retail bond. And they give you a stipulated time. Maybe the maximum time will be for a year of investment. The term of investment might be 1 year, or maybe it can be 2 or 3 years. But if you withdraw your money before those term or those years, it will be given to you, but a penalty you also need to pay a penalty for breaching the contract between you and the business. But what is the disadvantage of investing in the government retail bond? Retail bonds cannot be ceded to bank as security for obtaining a loan. Cannot be ceded means that you cannot use it as a collateral to obtain a loan. You get what I'm trying to say? You cannot use it as a collateral to obtain a loan. But we have other forms of investments which can be used as a collateral to obtain a loan. Number 2, a minimum of 1,000 Rand must be invested, which may be difficult for some small investors to accumulate. The minimum amount of investment is 1,000 Rand, which might be too, it means that it's not giving, how can I say, chance to anyone to invest in that, because some people might not be able to afford 1,000 Rand as a form of investment in the government retail bond. Number 3, retail bonds are not freely transferable amongst what? Investors. Is not freely transferable. In terms of shares are freely transferable, but the government retail bond is not freely transferable amongst investors. Maybe you're tired of investing in the government retail bond. It's not easy to transfer it to someone that is interested. Investors need to have what? A valid SA identification, should be older than 18 years of age. So a valid South African ID is required. So those people that are even South Africans and they do not have ID cannot invest in a government retail bond. And before you can do that, you must also be older than 18 years of age. And let's look at the unit trust. What is the advantages of investing in the unit trust? Number 1, it is managed by a knowledgeable fund manager who buys shares on the stock exchange. So which means it is being managed by JSE on your behalf, and it is being done by experts that knows more about the economic situation. It is a safe investment as it is managed according to rules and regulation. A small amount can be invested per month, which can be less than 1,000 Rand. Easy to invest in as investors simply fill in several forms, or you can do it online. Easy to cash in when an investor needs what? Needs money. You can put your money in a unit trust and you can just be taking out your dividends, or what we refer to as profit. But what is a disadvantage? If blue chip companies' growth path decline, the growth of the unit trust will also be affected. It will be affected. Number 2, unit trust holders are not allowed to borrow against their investment. You are not allowed to borrow against your investment, like using it as a collateral. And number 3, not appropriate for short-term investment. So a unit trust is not something you're going to cash, or you expect a bigger dividends within the next 1 year or 2 years. It actually need to be in there for like 3 to 5 years before you can get a good return on that kind of investment. And not advisable if investors want to avoid risk at all costs. It's not advisable if investors want to avoid risk at all costs. So which means it has a kind of risk, not like a government retail bond that doesn't have any risk. Unit trust has a risk. At least it still has a small risk. So in a situation whereby you want to go for an investment that has no risk, there's no way you can choose the unit trust, because the unit trust has a risk. Then we have shares. What is the advantage? It is an ownership of a large number of shares. Ownership of a large number of shares may result in higher proportional dividends payout So which means the more you buy, the more shares you buy, the more dividends you're going to have. Can be freely transferred or traded on the JSE. You can give it to your dependent, it can be given to your children, or you can even give to someone that is interested when you are no longer interested. Shareholders' liability to the debt of a company is limited to what was invested. Shareholders have limited liability for company's debt. We spoke about limited liability, that is, personal belongings cannot be confiscated or be sold to pay debts or to the creditors. Holders have voting rights at the annual general meeting. Yeah. What is the negative? Holders may receive less dividends, no dividends when companies' profits are low. And that one is actually focusing on the ordinary shareholders. Holders may receive less dividends, no dividends when company profits are low. Companies have no legal obligation to pay dividends to shareholders. No legal obligation in terms of being an ordinary shareholder. Risk may be high as investment may be lost when companies are liquidated. Dividends declared are determined by the management, the directors of the company or the business. Then lastly, we have the fixed deposit. A fixed deposit, what is the advantage? Interest is earned at the fixed rate regardless of changes in the economic climate. So people that have lump sum of money being fixed in the bank will always enjoy a fixed rate irrespective of what is going on in the economy. And number two, the investor can choose the investment period. Some form of investment will tell you you can only invest it for 1 year, you can only invest it for 2 years. But for fixed deposit, you as an investor can decide to choose my investment period. Okay, I want to invest it for 3 to 5 years. It has a low risk as investors are guaranteed a final payment. So because you have a fixed deposit in the bank, you have been given the interest rate, which is fixed, and you also know the terms, like for how long do I want to keep that money in the bank, maybe 5 years. You can actually calculate your what is going to be your final payment at the end of the term, maybe at the end of 5 years. So it's something you can actually plan on when you have a fixed deposit in the bank. But what is the disadvantage of fixed deposit? Number one, the investor cannot withdraw the funds before the maturity date. So if I'm